Today we have a brief market update. So let's start with talking about trading channels. And if you look back at the price action going back to October 2022, really all of it has been pretty well captured within this long trading channel, right, in blue here. And within that, there have been 5 different periods of uptrending action. Each one of those as well can also be encompassed within trading channels. Of course, they're smaller and more narrow, but at the same time, as we can tell, each of them has been able to extend up until hitting the upper level of the larger channel. And most of the time, that's also coincided with getting to the top of the smaller channel as well, including what's happened over the last few weeks. So we've been noting this for our premium subscribers since that time, understanding that this was a very good run, but it too was getting close to the upper edge of this pattern, which of course has led to some of the biggest drawdowns we've seen now going back almost 2 years. And so market's still relatively close to its highs, but we know that the underlying volatility with the rotation has been historic. As we know, the Russell has done a number of things we've never seen before. And so the question is, of course, is this going to have a greater effect on the S&P 500 more than we've seen so far? And so we're going to get a good understanding that the 1% moves start to change in a material way once more. And so far, still relatively tame. We've had now 2 1% gains in July versus 1% loss. And as we can tell, the count is still in favor of 1% gains. And that's important because we know that the key traits of an uptrend that we always talk about is, number one, you want to see a low frequency of 1% moves overall, both up and down, as we can tell that is the case, and more 1% gains versus 1% losses. That happened in 2023, which led to a good year. It's happening in even more recognizable way this year, where again, we have a fewer number, 1% moves overall, and double the amount of gains versus losses. Quite simply, if this scenario continues, then we should expect the uptrend to continue as well. So what's going to change that? Well, if we get clusters of 1% moves, meaning that two-way volatility comes back much more than we've seen so far. And this has been the case now a few times over the last number of months. We can see really a number of different phases of the market. We have classified here from April 4th to May 6th, the S&P endured 9 1% moves all along this way in 23 trading sessions, were close to 40% of the time. So 40% of the moves were at least 1%. 5 up, 4 down, that's two-way volatility. And not surprising, that encompassed the majority of the spring sell-off and also the comeback from that point. As we know, when things turn, you often get volatility as well. And so you go now to the period right after that, specifically from May 16th all the way to July 9th here, there were just 2 1% moves, both gains across 36 trading sessions this time, or just 6% of the time. Again, not surprisingly, the market's trend was up during that time frame. And that brings us to right now, where, again, not too much to go by just yet, but currently since July 10th, over here, there have been 3 1% moves, as we just talked about in July, over 9 trading sessions. So that's 33% of the time, which is a high amount, should it continue. The clear difference at the moment is that it's only been 9 days. So if the point is, if that pace continues, then we'd expect this sell-off to continue as well. It's really about patterns at this point. And so the current live pattern is still just the big one we have here. The breakout from January 19th here gave us the 6,100 target we talk about all the time. That continues to be in play, and it will be just because of how far above the S&P continues to be from the 4,800 breakout area. So we care more about the short term. And we talked about in the past that we needed some sort of pullback to at least give us an indication of what could come next. And so right now, we're still in wait and see mode because we can have both a bullish potential pattern like this with the market coming down. This is the very early stages, but anytime you see the market at least rally from a low, there's a potential for something like this to form. You rally back up to a previous high, you form a higher low and break out from there. We've seen it over and over and over again, as we know, going back since October. At the same time, a pause eventually could lead to a bearish pattern as well. And this is just one iteration of where it could occur. And as we know, all the bounces we just saw on Monday, July 22nd, if they fail, could produce lower highs across the board and give us something like this. And so with this, we know that the bearish patterns, especially for the S&P, just have not played out since last October. It doesn't mean that this will continue. We have to respect the fact that any bearish pattern could eventually resolve to the downside. So that just means be patient, wait for the breakout, breakdown, respect it, and act accordingly from that point. That's it for today. Don't forget to check out these videos and subscribe. And I'll talk to you next time. Thank you.